This video is on risk tolerance. Now, risk tolerance is a very, very important concept in finance. And it's a concept that I think people could spend a little bit more time really understanding. It's that important. And so that's why I'm making this video. Risk tolerance is basically a pretty simple concept. It's the idea that each financial decision has two components. It has market forces, what's going on in the market, and then it has the individual investor's situation. And the idea is that if you evaluate both of these components, aligning these components will give you the best financial decision. So I'm going to put up some charts to kind of give you an abstract understanding of what this means. And the first chart is going to show two axes, and it says on one axis is risk and the other axis is return. And so this is the concept that we've been discussing. It shows that the higher the risk, the higher the return. And this is all about understanding market forces. If you understand this curve, you're understanding what is going on in the market. What are the investment opportunities that are out there? So now I'm going to put up a second curve. And this curve is all about understanding individual investors' situations. And so this curve says the higher the risk, the lower the peace of mind. So it's trying to say for an individual investor, the more risk they take on, the less peace of mind that creates for that investor. So the idea is that when you combine these two charts, based on what's going on in the market and based on what's going on for the individual investor, where those two lines intersect is going to be that sweet spot, that point where an investment has the right amount of risk for the individual investor. And that's what we're trying to do here. We're trying to align the riskiness of investment decisions with the appropriate level of risk for that investor. And because each investor has a different financial situation, that point is going to be different for every situation. So when we talk about risk tolerance, it's all about understanding this second part, the individual investor's situation. So I'll give you an example. Let's look at the first curve, where the higher the risk, the higher the return. You can be a brilliant investor. You can be just really understanding the financial markets, really understanding what market forces are doing, and making brilliant financial moves at the very high end of this risk-return spectrum. But if your individual situation does not warrant that level of risk, then it doesn't matter how brilliant those financial decisions are, it's not appropriate for your financial situation. And perhaps better financial decisions could be being made at lower levels of risk. So, the problem when you talk about risk tolerance is that it's very difficult to quantify. It's very hard to come up with a quantitative number for this is your level of risk tolerance. So how do we calculate it? Well, what normally happens is if you go to a financial professional, usually what they do is they have some kind of survey, and they try to get a general overview of your financial situation. And so you'll fill out this survey, and it will ask you things, like what is your level of savings, how much are you saving every month, what types of investments do you have, and they get this picture of your overall individual situation, and then make a determination on what's the appropriate level of risk for you. What would make you feel the most comfortable? So that's how it's normally done through these surveys. And that makes it really difficult because it's not always a hard number. It's about understanding the full situation. But, I think there is quantifiable information in here that is helpful to understand. Because when I look at risk tolerance, the main driver always comes back to one thing. It comes back to what is your reliable monthly income. So, you have all these financial factors, but the main impact on how you're making your investment decisions, it's going to be what is your income every month and how reliable is it. So let me give you a couple of examples of this. So I'm going to put up some different examples in this chart here. And on one side we have the more risk-averse option, and on the other side we have the less risk-averse option. So the most common example of risk tolerance is someone nearing retirement. So someone nearing retirement, their main driver is, again, reliable monthly income. But if you're nearing retirement, that monthly income is going to end very soon. And so you're going to be more risk-averse than, for instance, somebody with many years of income earning potential. So there you have that comparison between two different individual investors with a different level of risk tolerance based on the reliability of their monthly income. So let's take another example. Let's look at job security. So someone who has low job security is going to be more risk averse than someone who has a very stable job. Because, again, it comes back to the reliable monthly income. If you're worried about losing your job, you need to be concerned about having enough savings to make up for a loss of earning potential. So you have those two different options. Low job security is more risk averse. A stable job is less risk averse. Let's look at another one. Smaller paychecks versus larger paychecks. So if you have more money coming in, you're going to be less risk averse and able to take on more risky investments. Someone with a smaller paycheck is going to have less money to invest, so they're going to be more risk averse or willing to take less risky investments. And again, this comes back to the idea of finding what's the most appropriate financial decisions for your individual situation. So I got one more example for you. Someone with one income stream versus someone with diversified income streams. So let's say, the diversified person has a paycheck coming in, they have like rental income, they have investment income, they have all these different streams of income coming in every month. Well, one person with only one income stream is not going to be as reliable as someone with a diversified portfolio. So again, that makes their outlook on financial decision making different based on their individual situation. So I hope walking through these examples is helpful. The key is you want to understand risk tolerance because it helps you make better financial decisions. It's important to thoroughly understand your situation to decide how far up that risk-return scale is appropriate for you. Because what we want to do here is we want to help you achieve your goals in the most financially responsible way possible. And the main monthly driver of risk tolerance is going to be the reliability of your monthly income and how much money you're willing to lose. So, to recap, we talked about risk tolerance in this video. I gave you a definition of risk tolerance. We talked through assessing your risk tolerance and what that means, and then we gave some examples of different risk levels. So again, this is a really important concept to understand, and I'm going to make another video on it, and in the next video we're going to take specific quantifiable values and talk about what that means for risk tolerance.